Hi everybody, this is a lecture for Wednesday 5th of January 11 a.m. So today you will learn a new topic. Actually it is a subtopic. So you are still in topic 6 and you will see the accounting for current asset inventories. Okay, in the previous lecture, you have learned about accounting for current asset cash and then accounting for current asset account receivable. So in this lecture, in this subtopic, you will learn about another current asset, which is inventories. Inventories only merchandising and manufacturing businesses will have inventories. Merchandising and manufacturing businesses, they sell something. They sell products. That's why they have inventories. A service business does not have inventories. That is because a service business does not sell anything, but provide services only. So remember, only merchandising and manufacturing businesses have inventories, and inventories is a current asset. Okay, so let's see. Define inventory and cost of goods sold. What are some of their characteristics? Okay, what is inventory? Inventory is goods either manufactured or purchased for resale. So if the business is a merchandising business, if the business is a merchandising business, for example, a grocery shop, then inventory is goods purchased for resale. So let's say you own a grocery shop. So what is your inventory? Your inventory is the rice, sugar, bread, what else? Salt, and everything that you purchase from supplier that you will sell to customer. So these are called inventory. But if you have a manufacturing business, let's say you have a small factory producing frozen food, so what are your inventory? Your inventories are goods or material that you purchase from supplier that you will use in the production process, and later you will sell them to customers. So these are your inventories. Okay, see the next point. Inventory is reported on balance sheet as an asset. So remember, if you have a merchandising business or a manufacturing business, inventories are asset and they are current asset. They are current asset because their useful life is less than 1 year. Most of the time, if you have a business, your inventory, you will sell your inventory very quickly. So the life of the inventory is less than 1 year. You purchase things from supplier today, you want to sell it quickly. After that, after you sell, you will purchase again from the supplier, and then you want to sell it very quickly. So inventories are current assets. Okay, and then the next point, When sold, inventory is reported on income statement as an expense, which is called cost of goods sold. So the nature of inventory is like this. If you have a merchandising business, for example, you have a grocery shop. So when you have the things, the rice, sugar, and bread, etc. in your shop, they are called inventories. They are asset of your business. But when you sell them, they become cost of goods sold or an expense. When you have these inventories, you report the inventories in the balance sheet as a current asset. But when you sell the inventories, you record you record them as cost of goods sold, and the cost of goods sold will appear in the income statement of the business. So cost of goods sold or COGS is the cost of inventory sold during an accounting period. So let's say you have a grocery shop. You sell 20 kilogram of rice. You sell to the customer 10 kilogram of rice. You sell 10 kilogram of rice to a customer. You sell that for $40. That is the revenue. You sell to the customer $40. That is revenue. But the cost of the rice you purchase from supplier, let's say the cost of the rice you purchase from supplier is $30. That $30 has to be recorded as cost of goods sold, cost of the item that you sell to the customer. Okay, you will see that later when you learn about how to prepare income statement for merchandising business and manufacturing business, how to calculate the cost of goods sold. Okay, this is like introduction to this subtopic on inventory. So by knowing this, maybe you will understand more about the inventory. Okay, so this is the timeline of business, and it is actually timeline of a manufacturing business. So for a manufacturing business, the process is started with purchasing or buy raw material from supplier. If the business is a merchandising business, then it is started with purchasing goods for resale from supplier. And then if the business is a manufacturing business, the next step in the timeline is to add value to the material by assembling the material to become a finished product. And then after that, the timeline is to sell the inventory. When a business sell its inventory, the cost of the inventory will be recorded as the cost of goods sold. And then the inventory that is unsold, or inventory that is still unsold, is called ending inventory. So let's say you have a merchandising business. At the beginning of the year, you have 20 bags of rice. At the beginning of the month, you have 20 bags of rice. So that is the beginning inventory. During the month, you sell 15 bags of rice. That will be recorded as cost of goods sold. The cost of the rice that you sell to customer will be recorded as the cost of goods sold. At the end of the month, you have 5 unsold rice, 5 bags of unsold rice. So that 5 bags are the ending inventory. Okay. So this is again the definition for inventory. What is inventory? Define inventory according to type and nature of the company. So let's see, I think I have explained about this. So for a merchandising business, like a small, like a grocery shop or a supermarket, inventory means items to be resold. So let's say you have a grocery shop. So things that you purchase from supplier like rice, sugar, bread, etc., that you want to sell to the customer, these things are called inventory. But if you have a manufacturing business, let's say you have a factory that produces frozen food. So you will have three types of inventory. First, you will have raw material inventory, the things that you purchase from supplier to make the material that you purchase from supplier that you want to use to make the frozen food. For example, you will purchase flour, sugar, butter, salt, what else? Colorings. So these things are called raw material inventory. And then if you have a factory or you have a manufacturing business, you will also have work in process inventory. Work in process inventories are things that are partially finished or partially completed. So the thing is like this. Let's say you have a factory that produces frozen food, and then the factory has started operation at the beginning of the month. At the end of the month, or at the end of an accounting period, you have to stop. Remember, you have to stop recording. So at the end of the accounting period, you stop recording, maybe at 31st of December, and then one of the things that you have to do is you have to check your inventories. So when you stop production and accounting record at the end of the year, you will see you will have three type of inventories. First, the raw material inventory, and then they are partially completed product. It means that frozen food that are still not finished yet. Maybe the mixing process has been done, but the packaging process is still is not done. So that is called partially finished product. That is a type of inventory also for a manufacturing business or a factory. And then also, if you have a manufacturing business, when you check your inventory at the time when you close your account, you will have another type of inventory, which is called finished goods inventory. Finished goods inventory are inventories that are ready to be sold to customer. That is for manufacturing business. So just keep in your mind. Just remember, if you have a merchandising business, you will have only one type of inventory, which is called finished goods inventory. But if you have a factory or a manufacturing business, when you close your account, you will have three types of inventory: direct material inventory, work in process inventory, and finished goods inventory. These three types of inventories, you have to show them in the balance sheet of the business. And then if you have a service business, for example, you have a laundry shop, do you have inventories? The answer is no. A service business does not have inventories because a service business does not sell anything. Merchandising business sells something. Manufacturing business sells something. Sells something. But a service business does not sell anything. If you have a laundry shop, you provide laundry service. The only thing that a service business has is things that we call supplies. Supplies are things that a service business use when the business providing services. For example, if you have a laundry shop, it is a service business. It does not have inventories, but when you provide laundry service, you will use detergents, softeners, to do the laundry. So detergent and softeners, in accounting, you have to record them as supplies. You cannot record them as inventory because your laundry does not sell detergent and softeners. Your laundry business uses the detergent and softeners when services are provided to customers. Okay, remember that. Okay, this is the definition for each manufacturing inventory. I think I have explained about this. What is raw material inventory? What is the work in process inventory? And what is the definition for finished goods inventory? Okay, now. Okay, this is something. Now you have to learn how to record transactions related to inventory. If you have a business, let's say you have a small grocery shop, so you have to record the transactions related to inventory. So one of the things that you have to know is when you want to record the cost of the inventory, what are the things that you have to consider? So see here, what costs are included in inventory. So when you want to record inventory, the value of the inventory includes first costs incurred in buying inventory and preparing it for sale. So all the costs that you have to pay when you buy the inventory, for example, the delivery cost also, the maybe insurance cost to cover for the delivery of the inventory, and also all the costs that you add when you prepare the inventory to make it ready for sale. These costs are also included in the value of the inventory. The cost of the inventory includes cost of the raw material, cost of work in process inventory, and cost of finished goods inventory. The cost of the inventory, see the yellow box there, the cost of the inventory does not include sales effort, advertising costs. That is not inventory cost. Advertising costs and also general admin costs, that cost is also not included, not to be included as the value of the inventory or the cost of the inventory. It is not very hard when you see the way to do the recording process. This is another one. This is like the introduction. This is again the same. The thing that is related to cost of goods sold, and don't have to worry about this. Okay, so now you are learning about how to do accounting record for transactions related to inventory. If you have a merchandising business or manufacturing business, you will have inventories, and then you will have to do transactions related to inventories. The first, for example, when let's say you have a grocery shop, you have to purchase the inventory from supplier. Okay, that is one transaction. So how to record that purchase? There is a way to do that. So you will see the way in this subtopic. And then if you have inventory, later you will have to sell the inventory. So how to record that? How to record the sales of the inventory. And then how to record things like delivery costs, when you purchase inventory, you have to pay for delivery sometimes. So how to record that? So these are the things, these are the transactions related to the inventory, and here you will see how to record them. So there are two methods that can be used to do accounting or recording for inventory. The first method is called perpetual method. The second method is called periodic method. Okay, perpetual method, most of the time, this method is used when a business sell high value product or expensive product, and the quantity that the business sells is small. Okay, for example, let's say the business is a jewelry business. A jewelry business, every jewelry, the ring, the bracelet, the things that I don't know how to pronounce them, ring, bracelet, what else? I don't know about jewelry. I only know two, ring and bracelet. They are very expensive, hundred of dollar, thousands of dollars. So if you see a jewelry shop sell very expensive item or product, and the quantity of the product or item that they sell can be set as small quantity. Maybe if you enter a jewelry shop, maybe there are only several hundreds of item only, compared to you enter a grocery shop. If you enter a grocery shop, there are thousands of things are sold in even a small grocery shop. Imagine they will sell many things in a grocery shop, thousands of things, like compared to a jewelry shop. If you enter a jewelry shop, maybe there are several hundreds of items only, but you enter a grocery shop, thousands of things: sugar, rice, bread, biscuits, many things, fish, sometimes fresh product like fish, vegetables, thousands of things, many things. Okay, so if a business is sell expensive items or product and sell these things in small quantity, most of the time the business will use a system to record the inventory, called perpetual system. But there is a second method to record inventory, and this second method is called periodic system accounting for inventory, or periodic system, the system used to record inventory. Periodic system is used most of the time if the business has large number of inventory and diverse types of inventory, and each inventory is relatively low value. So the typical example of business that will use periodic system to record inventory is the grocery shop. Like I said earlier, if you enter grocery shop, there are many thousands of items they sell. Some of the item is very small, like needles, threads, very small. So that's why even a small grocery shop can sell thousands of things. The inventory of this business are diverse, many things, and then the quantity of the inventory are big quantity, thousands of things. And also each item is most of the time very very cheap. Like some item is like 20 cents per item. The candy to be sold to children is like 10 cents per item, or 10 cents per item now. So this kind of business most of the time we'll use periodic system to record inventory. So you will see in the next slide how to record transaction related to inventory using perpetual system, and how to record the same transaction using periodic system. Okay, let's see. One of the things that you have to know is, if a business uses perpetual inventory system, then the business will remember the business has sells expensive items, and the business most of the time has small number of inventory. The example that I use is jewelry shop. Each item is very expensive, and the business will have like small quantity or number of items that they sell. But for periodic inventory system, this system is used mostly by a business that has many types of inventory, large quantity of inventory, and each item of inventory is most of the time cheap item. Okay, let's see how to record purchases using perpetual system and periodic system. Perpetual system has a characteristic like this. If a business uses perpetual inventory system, every time the business purchase inventory or sell inventory, the business will update the inventory account. The inventory account will be updated using this system because it is easy for the business to do the recording, because the quantity of the inventory is not big. The quantity is small. Like a jewelry shop, several hundreds items only, so easy for the business to update the increment or decrement in the inventory account. But if for a periodic system, if a business uses periodic inventory system for recording, the business will not update the inventory account. The business will record the purchase of inventory and sales of inventory in a specific account. You will see that. Okay, now let's see purchases. Okay, for how to record purchases, see here, if the business uses perpetual system, all purchases are added directly to the inventory account. But if a business uses periodic inventory system, at the end of the accounting period, inventory balance is updated using inventory account. But temporary purchases account balance is close to inventory to compute COGS, cost of goods sold. So if a business uses periodic inventory system, every time the business purchase something, the business will update account purchase, will use account purchase. So let's see, there is an example. So this is an example. Okay, the example is based on this scenario. See here, accounting for inventory purchases and sales. The business is Harper's Hat. Below or followings are the transaction in the year 2017. See here, for example, at the beginning of the year, the business has beginning inventory. Beginning inventory is the inventory carried by the business from the previous year. Inventory from the year 2016. So at the beginning of the year, the beginning inventory is 10 heads at $10 each. And then at 1st of March, the business purchased 15 heads at the price of 15 each. The freight in is $10. Freight in is the cost the business pay to get the head. And also at the March 1st, the business returned 3 heads. So this thing always happen. If you have a business, a merchandising business, when you purchase things from supplier, sometimes the things expired, or the things are not according to your specification, so you return the things or item to the supplier. So in this situation, the business purchased 15 heads, and the business found that 3 heads, something wrong with 3 heads, so the business returned the 3 heads to the supplier. When a business purchase inventory, the inventory goes in, asset goes in, because the business receive inventory from supplier. But when the business makes a purchase return, when the business return several items to supplier, the asset inventory will decrease. When the business makes purchase, asset inventory increase. When the business makes purchase return, the inventory will decrease. So in this example, the inventory will decrease by 3 units, 3 heads. So see the next transaction is May 2nd, or 2nd of May, the business again purchased 10 heads. This time at the price of $20 each. And at the 2nd of May, the business received purchase discount, 2% or 2/10 and over 30. I will explain that later. At 30th of June, the business sell 20 heads. Okay. And in 3rd of July, the business received sales return. So when a business sells something, inventory goes down or inventory decrease, because imagine you have a grocery shop, you sell something, your inventory will decrease. Your revenue increase, but your inventory decrease. And then sometime you sell things to customer, and then the customer does not happy. You sell 10 things or 20 items to customer. Maybe the customer does not happy with one item. So the customer, the thing that can happen is the customer will return the item. So if that is the situation, if a customer return items that you have sold to them, in accounting we call that situation as a sales return transaction. Sales return means customer return items to the business. So when a business sells something, inventory decrease. But when there is a sales return, or customer return items that have been sold to them before, the inventory will increase because you receive inventory from customer. And then the inventory that are unsold is called ending inventory. So let's see how to record this. Okay, see, this is the way to record purchases of inventory using perpetual system and periodic system. Remember, if you use perpetual system, you will update account inventory every time you sell or purchase inventory. But if you are using periodic system, you will not update your account inventory. You will only update your account inventory at the end of the accounting year. When there is a purchase, you record in account purchase. When you sell something, you record in sales account. Okay, see here. Harper, the business, purchased 10 hats at $10 each on 1st of January. Record the entries for both perpetual and periodic system. So if you use perpetual system, this way is the way to record the inventory, record the purchase of the inventory. So 1st of January, you record the purchase. When there's a purchase, you debit account inventory. 10 hats times $10 equal to $100. So if you use perpetual system, you debit account inventory $100, and you credit account. In this situation, you credit account payable, assuming that the business purchased on credit. If the business purchase using cash, so the journal entry is debit inventory $100, credit account cash $100. So account payable is used when the purchase transaction is done in credit. Okay, but if you use periodic inventory accounting system, the way to record this transaction is like this. The date is 1st of January, and then, like I said earlier, when the business purchase something, and you use periodic system, you debit account purchase. In this situation, the amount is $100. Credit account payable $100. To see the difference, if you use perpetual system, you will update account inventory every time you purchase inventory or sell inventory. But if you use periodic system, you only update the account inventory at the end of the accounting period. When you purchase something or sell something, you will use account purchase and account sales. So in this situation, the account purchases is used. Okay, that is one example. Okay, now how to record transportation costs. Remember this thing. Remember how to record the value of inventory is included the cost that you have to pay to acquire or to get inventory. So transportation cost can be the amount that you have to pay when you want to get or to purchase inventory. So if you use perpetual system, all costs are added directly to the inventory balance. But if you use periodic system, you have to use account freight in. Freight in is like the transportation cost. Okay, let's see the example. Okay, Harper hired a trucking company to deliver its March first purchase of 15 hats. The trucking company or the transportation company charged $10. Record the entries for both the perpetual and periodic system. So see here. So if you use perpetual system, this $10 you debit account inventory. So under perpetual system, 1st of March, you debit inventory $10, credit account payable $10. Assuming that the transaction is done in credit. Okay, but if you use periodic method, always remember if you use periodic method, you do not update the account inventory. You update the account inventory only at the end of the accounting year. So when there is a cost like this, you use account freight in. Freight in $10, debit freight in $10, and credit account payable $10, assuming that this transaction is done in credit. If the transaction is in cash, you have to credit account cash. Okay, purchase return. Remember purchase return? The purchase return is something like this. There is a business. The business purchase something from supplier, and the business does not happy with the thing that have been purchased. So the business return the item to supplier. So purchase return is things like that. Okay, let's see. If you use perpetual system, you update the account inventory. You credit the account inventory because when a business do purchase return, inventory goes out, inventory decrease, so you credit account inventory. And also account payable or cash is decreased by the same amount. Okay, and then see if you use a periodic method. If merchandise have been paid for, the supplier will reimburse. So you debit cash, and then at the end of the period, the temporary account purchase return account balance is close to inventory to compute COGS. So if you use periodic system, you do not update account inventory, but you use account purchase return. So let's see the example. See here. The example of journal entries for purchase return. On the 5th of the 15 hats delivered on March 1st, 3 were defective, and Harper, the business, returned them the same day. Record the entries for both the perpetual and the periodic inventory system. Remember perpetual system? The system update the inventory account. So when the business returned the 15 hats, the 3 hats, the value of these 3 hats is $45. 3 hats times $15. So the inventory decrease. When the business do purchase return, the inventory decrease. Inventory is an asset. When the inventory decrease, you have to credit the inventory. So credit account inventory $45. At the same time, you have to debit account payable because the account payable also decreased by $45. When the business return the 3 hats to the supplier, the account payable is also decreased because the business does not have to pay the $45 anymore. So the account payable decreased by $45. But if the business uses periodic system, when the business do purchase return, the business has to record that in an account called purchase return account. So see here, the second yellow box. And using periodic inventory system, the business has to credit account purchase return $45, and then debit account payable $45. So what else? Purchase discount. Say the situation is like this. If you have a merchandising business, when you purchase inventory from supplier, sometimes you will get discount from the supplier. Particularly if you purchase in big quantity. Let's say at one time you purchase 100 kilogram of rice. 100 kilogram of rice is not many. Let's say 200 kilogram of rice, and then the supplier give you 2% discount or 3% discount or 5% discount. So that is called purchase discount. The discount that you get when you do purchases. Okay, if you use perpetual inventory system to record transactions related to inventory, you have to update the inventory account. the purchase discount will decrease the value of inventory because you got discount. Before discount the price is $200. After discount the price is $190. So the value of the item decreased by $10. So but if you use periodic accounting system, periodic system to record inventory, you will not update the account inventory, but you will record the purchase discount in an account called purchase discount account. When you prepare the income statement, you have to show the purchase discount. The purchase discount will decrease the value of the cost of goods sold. Let's see the example. On 2nd of May, Harper, the business that we use as an example here, purchased 10 hats at $20 each. The supplier offered term of 2/10 and over 30. Record the entries for both the perpetual and periodic inventory system. So see here the term of the purchase 2/10 and n over 30. So what it means by 2/10 and n over 30? 2/10 means if the business pay the supplier within 10 days, the business will get discount 2%. N over 30 means that the business has to pay to the supplier within 30 days, not more than 30 days. Okay, so that is the meaning of for the terms here. So let's see how to record that. Like I said earlier, if you use perpetual inventory system, you have to record you have to update the account inventory. So in this situation, the business purchase 10 hats at $20, so inventory will increase. Imagine Harper business is your business. So when you purchase 10 hats, the supplier will send 10 hats into your business. So your asset hats increases. So inventory increase, you debit account inventory $200. $200 is the 10 hats time $20. At the same time, the business this is something wrong maybe, I think. So if the business pay this purchase on the same day, okay, the business pay the inventory on the same day, then the business will get 2% discount because the term of the purchase is 2/10. 2% discount. So if to record that discount, if you use perpetual system, you debit inventory 200. At the same time you credit inventory for $, because using perpetual system the purchase discount is recorded by crediting or reducing the value of the inventory. But if you use periodic inventory system, when you purchase the inventory, you record the purchase in account purchases, and then you record you debit the account purchases, in this situation $200, and then if the business receive purchase discount, you have to debit you have to credit account purchase discount. There's something wrong with this account payable. If the business pay on the 2nd of May, then you have to credit account cash, because when the business pay, the cash will decrease, cash goes out. I am not sure why in this slide the slide shows that the business has to credit account payable. the business only get the purchase discount when the business pay the supplier. If the business pay within 10 days, then the business will get 2% discount. Okay, I will stop here. Thank you very much. Do not forget to write your name and matric number in the comment section of this video. I will record that as your lecture attendance. Thank you very much.